Investing is only about the future. Whatever you pay for an asset now, you don't care what happened to that asset in the past unless it tells you something about the future. And the common thread is understanding history in order to better see into the future and decide what investments to make. And more importantly, what investments not to make.
Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Laurence Siegel, one of the most respected thinkers in long-term investing and capital markets. In this conversation, we'll explore the hidden lessons from centuries of market history and why understanding the past can sharpen our thinking about the future.
We've just recently had a very dramatic event where the market fell 20% in a few weeks, came back almost immediately and then moved to new highs, which will convince some young person somewhere that there is no risk. The market can fall more than 20% and not come back. In real total return terms, which after adjusting for inflation and the dividend, for 16 years you didn't make any money. It could happen again.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode.
Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Laurence Siegel, one of the most respected thinkers in long-term investing and capital markets. Larry's career began in 1979 at just 25 years old when he worked alongside Roger Ibbotson to complete the now iconic Stocks, Bonds, Bills, and Inflation historical study of asset returns. That early work sparks a lifelong engagement with financial history, not as academic credential, but as knowledge base and personal passion that shaped his approach to asset allocation and managing investment pools with long time horizons. Over the decades, Larry has led research at Ibbotson Associates, directed investment research at the Ford Foundation, and since 2009 has served as the Gary Brinson Director of Research at the CFA Institute Research Foundation, an independent, separately governed organization dedicated to advancing rigorous inquiry in finance. Along the way, he's consulted widely, published extensively, and written books like Fewer, Richer, Greener and Unknown Notes. He's also a member of the Voices of Influence program of the CFA that celebrates the investment luminaries who contribute meaningfully to the mission of the Institute through the Research and Policy Center. In this conversation, we'll explore Larry's unconventional career path, the hidden lessons from centuries of market history, and why understanding the past can sharpen our thinking about the future. Larry, it's an absolute pleasure to have you on the show. Welcome to The Blunt Dollar.
Well, thank you very much, Ignacio. And after that introduction, I'm not sure I can live up to it, but let's try.
Well, it's an absolute pleasure to talk with someone that has so much experience in financial markets and in the industry in general. And I'd like to start the show with a very simple question that I always ask my guests, but tell us a bit about your day today. What is it that you're doing exactly today?
Well, right now, the research director, or one of the two research directors at the CFA Institute Research Foundation, but that's a part-time job. And I'm actually going to go to emeritus status later in the year. So right now, I'm mostly wrapping up those responsibilities, editing books, evaluating and editing papers, trying to find new authors or new speakers for our series of podcasts, which I co-host. And then I do consulting for my clients. I only have a few. I'm reaching a point in my life where I don't want to overwork myself. I have no particular reason to. And then I, in my spare time, I write books.
Wow. That's absolutely amazing. I wonder how many hours you sleep per day. You seem like Elon Musk, like 3 or 4 hours, or how do you fit all of that in one
more
day?
like 9. Now, first of all, unlike Elon Musk, I do not have the desire or the ability to run a large business, much less 6 or 7 of them, or to be a billionaire. I just, if you set your sights low enough, you'll always exceed them. And I guess that's it's kind of an odd way to frame it, but I think that's kind of what I've done. I don't expect miracles out of myself or out of society to reward me for what I've done. Just right now, a semi-retired gentleman of leisure.
A very prolific semi-retired gentleman, I must say. And by the way, I forgot to mention this, but you already said it. You're doing a bunch of things out there, including podcast co-hosting. So please do go on the different streaming platforms or even YouTube and just type down Laurence Siegel. You'll see how much stuff Laurence is publishing and creating on a regular basis. He also has a website with many articles and interesting things to read. So please do check it out. Now, we've talked about your career. I mean, there's so many things you've done, from your early work with Roger Ibbotson to your research roles at the Ford Foundation and the CFA Institute Research Foundation. When you look back at all that career, what would you say is the common thread that ties it all together?
It's accumulating knowledge from the past, because investing is only about the future. Whenever you pay for an asset now, you don't care what happened to that asset in the past unless it tells you something about the future. And even then, it probably doesn't. So you really want to know what's going to happen. But we can't study the future. If we could, we'd all be billionaires like Elon. So you study what happened in similar circumstances in the past, or what didn't happen, that a risk that could have happened but didn't. For example, the great crash of 2008, we recovered fairly quickly because we learned lessons from 1929. And so the common thread is basically understanding history in order to better see into the future and decide what investments to make. And more importantly, what investments not to make.
So we're going to be talking about a few historical events during this conversation. But before we dig into that, I'm curious to some of your earlier parts of the journey. Namely, for example, when you were at the Ford Foundation, you were doing research yourself with a small support team. What were the biggest questions and tensions you wrestled with in your own research during that period?
Well, the big question facing a charitable foundation that has a pool of assets that's supposed to last essentially forever is, how do you allocate that money to various investments to, one, maximize the probability of, in fact, lasting forever. Nothing lasts forever, but you're trying to maximize the probability, and yet also grow the portfolio, grow the money so that you can give a lot of it away. And we were required to give away 5% of the portfolio value each year. That's the law, plus a small amount for administrative costs. So you're earning 5% plus a small amount, let's call it 5.2, and also keeping up with inflation means you have to earn about 8. And there aren't a lot of investments that pay 8 with any kind of certainty, but certainly in the bond market, you can get about 5. Anything beyond that is going to have a lot of risk. So you blend in risky assets like equities, and then which equities, how do you balance the need for stability, because the grantees expect a bigger grant each year, kind of like a university. The professors expect a raise every year, or they go work for a different university, and meanwhile not spend down the corpus and run out of money. So that's the balancing act. That's the dance you do with the capital markets as your dance partner.
Wow, that must have been fascinating. I mean,
It is.
researching that, and I'll say, like achieving 8% on a yearly basis with all the ups and downs, of course, that the market can have. Definitely not an easy feat. Even though we had a couple of course, good years in stock markets, and everyone is now saying, "Oh, but that's super easy." I'll tell you that over decades or even longer periods of time, is not an
Hey,
easy one.
if you think it's easy, start on January 1st, 2000. Let the clock run for 8.5, 9 years. See how easy it is. Of course, before that and after that, we've had fantastic markets. So over the full period, we made a lot of money. The Ford Foundation made a lot of money. Other investors made a lot of money. But you have to be able to withstand the down periods in order to stay in the game and enjoy the good returns when they do come. It's too easy to chicken out after the market. When the market's down, 20 or 30%, you say, oh, it's cheap and you want in.
Yeah.
But when it's down 50%, you're just scared out of your mind. It's going to go to zero. And that's exactly when you have to not sell.
Exactly. And yeah, I always find fascinating when the market, has a rally in the last couple of years, the amount of market gurus that pop up everywhere with all sorts of, advice and saying how easy it is and so on and so forth. But you really got to live one of those sharp sell-offs to understand that, markets are not always easy, and that it takes a special type of character to be able to withstand that kind of volatility. Now, talking about numbers, let's go even further back now. Let's go to your period at Ibbotson Associates.
Sure.
You helped develop the stocks, bonds, bills, and inflation study, which is a cornerstone on understanding financial and market history, I would say. Tell us a bit about what did you learn there, and which limitations did you encounter when it comes to historical data?
Well, the first thing I learned is it's not easy to make any money starting your own business. That if you think you've got a hot idea, but other people have similar ideas, and sometimes the market doesn't care what you think. So what we had, their big asset was this historical database of returns on the major asset classes in the world, starting about 1926 for the United States. And that it's an asset in the sense that people need it, but they're not really willing to pay very much for it. So we had to build a business around the sort of other things that people do with data that you don't think of initially. Initially, you say, well, let's sell the data. So we made a book out of it, charged about $100. You sell a few thousand of those, but when you've got a building full of people collecting salaries, you need to build on that. So we made first some software products, and then eventually Ibbotson Associates more into an advice firm. But it is it turns out that Michael Bloomberg had the key to riches, which is to sell real-time data. Historical data are probably more important to actually have in your possession, but it's worth less money. So we struggled for a while, but eventually Roger sold the firm for $80 million, which is an amazing amount of money for a little consulting and data firm.
Wow. That's insane. So this happened at the same time, basically, as Bloomberg and all these other companies, that data providers were being created, or before that?
Well, it was around the same time that Bloomberg came
Yeah.
into fruition in the 1980s. And you remember the movie, The Bonfire of the Vanities. Everybody was staring at their Bloomberg. They weren't staring at their Ibbotson. But their knowledge base came from Ibbotson and from the academics who had, like Gene Fama, who showed that the market was more or less efficient and that it would be hard to beat the market. It wasn't obvious until the great the founders of modern finance, Harry Markowitz, Bill Sharp, to some extent Gene Fama, and Robert Merton, Fisher Black. Those are the kind of the big five. They founded the field in an intellectual sense. They didn't found the field of finance in an operational sense. People more like who worked at Goldman Sachs or Citibank, places like that. And when the two come together, you get a rip-roaring boom in the industry, which is just now beginning to slow down with indexing reducing the size of the industry instead of increasing it.
Must have
But
been
the indexing is good for the investor. I don't want to downplay that at all.
So now I wanted to ask you about your role at the CFA Institute Research Foundation, which, as we said, is an independent, separately governed organization from the CFA Institute. What role do you see the Research Foundation playing in the broader financial ecosystem?
Well, back when books got printed at the print shop, we said that our mission was to put books on shelves. And so that complemented the mission of the CFA Institute, which was to put people in chairs to take an exam and to give them a credential which says that they've not only learned a body of knowledge, but also passed some ethical tests or standards. And when you put the two together, you've got a good basis for saying that people are well prepared to enter the investment management industry. But the Research Foundation itself provides, supposedly cutting, or we hope it is, cutting edge research, but also things like tutorials and literature reviews, summaries, a body of stuff, reading matter, listening matter, viewing matter, occasional conferences and that sort of thing, to help people self-educate in their professional careers as investors.
So it's a pretty broad mission, I would say, but very, very cool. You must be consuming, digesting loads of very interesting information.
Yeah, we can actually write about almost anything. We've written about bubbles in the market. We've written about geopolitics, and we've written about capitalism for everybody. That was somebody who sadly passed away. That was his mission, so we gave him a contract to write about it. And then sometimes more technical issues, currency trading, something like that. But we don't do most of our research internally. We give grants or just ask people to do it for free to write for us. And then I or one of the other research directors will, vet it, edit it, polish it up, turn it into something that's digestible, and put it on our website. In a few occasions, we still print books.
Very interesting. Wow. Well, congratulations on all the good work that you've done over there, and for
Thanks.
all the amazing literature and other content that you've been publishing. It's been absolutely amazing to read some of it, and I just wanted to say thank you for that. Now I want to. Yeah.
So one of the themes that we've pursued pretty consistently over the decades is the equity risk premium, or what's the long rate of return on various investments. Equities being obviously the most important one. So we've conducted some roundtables, wrote those up as books, articles, and now video. So you might want to check that out.
Absolutely. And for the listeners that haven't done so yet, please do head over there. Check out the CFA Institute Research Foundation. There's plenty of interesting materials, widely accessible in many instances, and very, very interesting to consume. Now, I'd like to go back a little bit more in time now. So we're doing this interview backwards, but I now want to talk a little bit more about history and insights from the deep past.
Sure.
While you were researching at Roger Ibbotson and Gary Brinson's 1987 book, you came across evidence that the Balzac watermill near Toulouse operated with share trading, limited liability, and governance centuries before the Dutch East India Company. So how did you stumble across this discovery, and what made you realize it was significant?
Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Well, I don't remember where I first saw a reference to it, because this was 40 years ago, and I was reading about the history of capitalism and financial markets, and it occurred to me that if I was helping Gary Brinson and Roger Ibbotson write a book on investment markets with an emphasis on history, that I should at least mention that I had discovered through my reading that there was a company in France that had sold shares in itself and that they had traded as far back as the 1300s with some evidence of maybe the 11 or 1200s. So I mentioned this to a colleague, Will Getzman, who has since become a very famous finance professor. And of course, he can do some things I can't do. One of them was to get on an airplane and fly to France and spend, it must have been months, researching this. He co-authored a book, or maybe it was a series of papers, with a French guy who was already an expert on this particular security, the Bezocle watermill in Toulouse, France. And so we have a funny, Will and I have a very pleasant relationship here, because he thinks I discovered it and I think he discovered it. But that's better than it being the other way. And but I even if I did discover the watermill being the first issuer of corporate equities, he did all the work and made it into something that people now read about and talk about. So the theme here is capitalism, and the idea of capital markets goes back as far in history as you can physically dig. And sometimes it is a dig. The archaeologists are finding that there were some kinds of markets back in the 3rd millennium BC, not necessarily capital markets, but markets where people could not only trade goods, but trade various kinds of risk, trade futures on olive oil or something like that.
I love this story. I think it's fascinating. And yeah, I mean, when you are studying in university, you learn that the first publicly traded company was a different one than this one that you are alluding to, the Dutch East India Company.
Yeah,
exactly.
Right.
The Dutch East India Company. And now it turns out that we have to update all the uni curriculums, I guess. But it's really, really interesting.
Well, the Dutch East India Company was the first widely held stock. And it was the first stock for which you have a reliable time series of data that goes all the way through. Will Getzman has constructed a time series for the Bezocle watermill, but it has some assumptions. Sometimes you don't know what the dividend was, and the dividend was the only cash flow to the investor, because in those days stocks tended to be traded at par, and what varied was the dividend. So when the company was profitable, you got a big one, and when the company made a loss, you may be asked to put in more money, and so it may not have been completely limited liability. I know that Bezocle had capital calls on the investors. I don't know about Dutch East India.
Oh, that's interesting. Yeah, that definitely adds a whole new layer of complexity there. If you have to put in money whenever the company is not doing great, it changes the whole way you have to think about it.
Well, then it becomes more like private equity. Since everybody seems to want private equity now, it's good to learn what happened to private equity investors in the past.
Absolutely. And I think this Bezocle mill is just one example of how capital markets were organized in the past. But maybe could you tell us what lessons, if any, do you think modern markets, including private equity investors, could draw from how these enterprises were structured and sustained centuries ago?
Well, as I've told you offline, I'm not a professional financial historian. I think of myself really as more of an economist than a finance guy anyway. But what you learn is that the institutional structure of the world, how we organize companies to have a capital structure of equity and debt. We have a court system to enforce property rights. We have transparency so that you're required by law to reveal certain things about the company's operations that you might not reveal if it's not a public company. All that is absolutely crucial to the building of a prosperous society. We have never had a major period of economic growth that I know of, maybe that anybody knows of, without most of those characteristics. And so what about China? There are some pictures of a road that forks around a house that's built in the middle of the road because the property owner wouldn't sell to the government agency that was building the highway. It's obvious they have some property rights in China that actually we don't have in the United States. Here, they just take your house and build the road, and they give you some money, and you buy a different house. But yes, China has also grown prosperous, and I believe it's done that by following most of that formula. What it has not followed is free speech, but if they did, it'd probably be even more prosperous. And they may still move that direction.
Mhm. So I wanted to ask you about the role of chance in all of this, because your discovery of the Bazak mill wasn't the result of some targeted ancient finance project. It as you said, it emerged while you were researching a bunch of things. How often has serendipity played a role in the kind of insights that you've pursued or published over the years?
Almost always. You never find what you're looking for. You find something else. You decide that what you're looking for wasn't that important, and you go work on something else. I'm not sure I can think of a specific example right now, but it's just a feeling I have that that's how I work best, and that's how good researchers work best. Sometimes you just need to keep digging until you get to the pot of gold at the bottom of the well, but usually not. Usually it turns out that it's a pot of mud and the gold is somewhere else.
So I wanted to ask you also about using history as a conversation starter. One of the big things that I'm working on this year is storytelling. I think storytelling has a huge role to play in finance, and obviously history is full of anecdotes and things that capture people's imagination. And I think even if your focus is on ancient finance stories, like the one of this mill, capture the attention of people that are thinking about markets today. And I wanted to get your take on how do you use historical anecdotes in your work to make broader and more actual investment points.
Well, I had a professor, Deidre McCloskey, who became famous partly for saying that economics is storytelling. And examples are, Poland was poor, then Poland adopted capitalism, so now Poland is rich. And on the other hand, Zimbabwe was rich. Zimbabwe contracted a strange monetary disease which eliminated the assets of the citizens, although they didn't intend to do it. They did it in pursuit of something else, and Zimbabwe became poor. So that's the kind of storytelling that underlies all of economic analysis, and I credit Deidre with bringing that to my attention 50 some years ago, and we're still in contact. But in investment management, usually the stories are something. The stories that you hear are being pitched to you as a reason to buy something or sell something or take some action that makes a profit for somebody else. And it's only fair. That's what they should be doing. But a discerning investor has to distinguish the stories that are real or that are the result of luck or a one-off. If somebody tells you I bought NVIDIA when it was 36 and now it's 500, whatever the price is, that doesn't help me. it is the basis for a process by which you think about what's the next company or group of companies that's going to do that, but it doesn't help you understand anything about NVIDIA and NVIDIA's future, because the future is already in the price, and so you have to decide whether you think the future is brighter than the market consensus which produced that price, then you would buy it, or less rosy than the market consensus, and then you would either not buy it or sell it short. So that's kind of how I think about stories in finance, is that they are a basis for a more rigorous investigation, which involves quantitative as well as qualitative analysis. But there's another thing here, which is sort of grand themes. I like thematic investing. If you know what's going to happen in society because of your superior understanding of some aspect of business, or what people are going to buy, how they're going to organize their work lives, personal lives, so you can make money. Mm-hmm. One example is right now everybody's talking about AI. And what I hear is it's going to completely revolutionize human life, or end it. Maybe it'll cause human extinction. Believe me, it won't. But it's a tool. It can be used for good or ill. And we have heard this story before. We've heard it with nuclear power or nuclear weapons, electricity, automobiles, airplanes, the internet. We almost always underestimate the long run consequences of these new technologies, even though they get hyped up to ridiculous levels, and the stocks may get overpriced, but we overestimate their importance in the short run, and we underestimate their importance in the long run. I was having a conversation just a few hours ago over, I believe, email with a good friend who was talking about this, and he said, well, what is AI going to mean for business profits, and especially their cost structure? And he said, well, Walmart spends a lot of money on trucks. That's not going to go away. And I said, it's going to change, because in 100 years, the word truck driver is not going to be in our vocabulary. Yeah, sure, there'll be trucks or something to carry physical goods around, but they will drive themselves, and it won't be 100 years either. But that's a good, safe forecast. In 100 years, the word truck driver will sound as quaint to us as a horse and buggy, or as a buggy whip manufacturer does now.
No offense to any of the truck drivers listening the podcast. I think many of our jobs are going to be reshaped or are going to evolve with the advent of AI. But I also think there's going
there
to
will
be plenty
be
of
more
opportunities.
of them. That's the thing that I want to emphasize. Every technological change in the past that has eliminated a lot of jobs has created more. And there's only one fact you need to know. You don't need to know what the jobs were or anything. The unemployment rate has been about 4%, except during depressions and recessions, as far back in history as you care to look. 1790 is about when the data starts. 4%. 1890, 4%. 1990, 4%. It still is. Meanwhile, the population, at least of this country, has gone from 3 million to 334 million. So the number of people working has gone just crazy up.
Yeah.
That couldn't happen if technology were eliminating jobs and not replacing them with even more jobs.
That's an excellent point. Because I had heard or read a couple of studies making exactly the case you're alluding to with the industrial revolutions, how, with the arrival of the steam machine, for example, it's not that everyone got out of a job. It's just that new jobs emerged. People were doing other things. And we shall see. I mean, there's other people that think that at some point, almost everyone is going to get unemployed, and we're going to pivot towards this universal basic income model.
because machines are going to be doing all the work. But I'm like you. I think no matter what, there is opportunity. I don't think we're doomed. I don't think machines are going to replace all of us. It's just gonna
No, they're
things
not.
are going to change, and there will be other
That
things to be
doesn't
done.
mean that there's no risk to an individual from the change. My father was a
Exactly.
court reporter for 39 years. The union kept them from replacing them with you need sophisticated taping equipment because you need to know who's speaking when, and you have to have somebody to operate the equipment and repair it when it breaks down. But they're still working as court reporters are still taking, stenotype or shorthand or whatever the latest technology is, but there's a court reporter for each courtroom. Again, there will come a point where there will not be. So you have to find something else to do and keep your resume up to date and your skill set sharp.
Mm-hmm. I fully agree with that. I have another question related to the past. Some financial innovations, like, how do you pronounce tontines? Tontines? How do you?
Tontines.
Tontines and other early structures fade from view over time, but still hold valuable lessons for today's market. So tontines were once a popular way to pull capital and manage longevity risk, but today they're mostly remembered through trivia. Can you tell
Right.
us a bit,
Why
first of
don't
all,
you
what?
just say what they are?
Yeah, I was going to ask you, can you explain us, because you have done some studies on, you've explored tontines. Can you tell us, through your own words, what are they and what drew you to explore these?
Well, a tontine is basically a betting pool as to who's going to live longest. So you get a group of people together and they put some money in, and the ones who die lose their share of the money, and the ones who survive longest get the money. And there's some pre agreed upon formula by which you find out how much money you get. But the point is that if you live a long time, you're going to need more money. If you die soon, you need less. So it's the same principle as an annuity issued by an insurance company, except that if you try to organize your own annuity, you will fail. First of all, it's illegal, but because insurance products are very strictly regulated by the states and the U.S. government or the government of some other country. But it is possible to organize a tontine. The problem is, and this has been the source of a lot of humor in song and story and film, is that every once in a while somebody gets bumped off because they own a share of the tontine, and the tontine is worth more if they're dead. So there's a movie called The Wrong Box from about 1966 with Alec Guinness, which was about tontines and a murder mystery that arose because somebody wanted all the money.
The Wrong
And I
Box.
believe Agatha Christie also wrote about it in one of her stories. Why isn't it used more? Well, you see the moral hazard. But if the tontine is large enough, let's say it's 1 million people, the benefit of killing one of the people is so tiny that nobody's going to do that and risk being accused fairly of murder. So large tontines can be practical, and there's a book about it, it's called King William's Tontine, by a great researcher up in Canada named Moshe Milevsky, and the Research Foundation published one of his monographs, which was also about tontines, if I remember correctly. But he also co-authored something with Roger Ibbotson and some other people, more about long-term financial plans. So the tontines sort of crept back into the dialogue. I'm not sure you can actually invest in one at this point in time. But you can buy annuities, which have a similar payout.
I think tontines, I mean, you were talking about that moralizer problem. Obviously, not an issue if there's 1 million people. The problem is when there's only like 3 people or 2 people left from that initial 1 million people pool. That's where, you get into the scenario of that movie that you were alluding to.
and where
That's
weird
why we
things can
have
start to happen.
laws. That's why we have rules and regulations. Let's say that it's in the United States and the SEC or some other government body says, well, we're going to allow tontines, but they have to be organized by a big five bank, and they won't be allowed to make any payouts until a particular tontine has 10,000 customers.
Mhm.
Okay, well, if you're listening and you're the chief economist of the SEC, get to work, because that's a possible structure. Yeah, we don't want individual citizens going out and organizing tontines and then having a rash of murders and then a cute play about it by whoever's the next Agatha Christie. You have to do it in a serious way that takes into account the risks.
Absolutely. So I want to come back to the present now. We spent a fair amount of time talking about the past. You mentioned at some point during the first part of the conversation, indexing. You were there during the rise of index investing, which is obviously huge nowadays. And you worked very closely with some of the key intellectual and institutional champions that helped make it what it is today. What do you remember about those early days, and what do you think people most underestimate about what indexing would become? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Well, I think at the beginning of the indexing revolution in the 1970s, I remember when Jack Bogle of Vanguard, the founder of Vanguard, introduced the first index fund in 1976 for retail investors. That he had a lot of pushback from people, who he had to get money out of or support from, who said, this is never going to fly. You can't charge very much, but it's a lot of work, and you'll never beat the market. Who wants that? Now, if you go back a little farther, I think it was in the early 70s, the Wells Fargo Bank in California had a investment organization called Wells Fargo Investment Advisors, I guess. And I did a lot of work for their successor company, Barclays Global Investors, when that company was in business before they were acquired by BlackRock. They produced an early index fund for institutions. And the first index fund for institutions that was at all successful had one client, Weyerhaeuser, the big lumber company in the Pacific Northwest. Mm-hmm. And again, they had to put up with a lot of people saying, it will never fly, it'll lose money. People expect you to try to beat the market if they're paying you a fee, and you're a fool. You're a fool for investing in it. You're a bigger fool for betting your company's future on selling shares of these funds. Well, it turns out, I believe BlackRock is now the largest investment company of any kind in the world. And I'm very proud to have had a consulting relationship with its predecessor company, Barclays, where I think I did probably my best work. Although I was never a W-2 employee, I was deeply involved in the company. And what happened is that about half of all the assets in the United States now are indexed, which has saved investors about $1 trillion in fees so far. That's a lot of money. I know, $1 billion here and $1 billion there adds up to real money, but $1 trillion is still a lot of money. And that doesn't count the losses that were avoided by buying index funds instead of actively managed funds that didn't go up as much. Now, yes, I realize the best actively managed funds have done fabulously and have tremendously outperformed the indexes. The problem is you don't know which ones they're going to be in advance. And right now, I'm co-authoring a paper with which has been accepted at the Journal of Portfolio Management for later in the year on why active management is still worth pursuing for certain investors under some circumstances. And I'm not an all index all the time advocate, but I think that for most investors, it's the best bet they can make.
Let me know whenever you publish that paper. Very interesting in reading it. I recently read you should check it out, the Morningstar's active versus passive barometer, which
Yes.
it's publicly available, and it shows the basically the amount of active managers that outperform across different asset classes, passive funds. And I'll tell you something,
The
not a
number's
lot.
always less than half, isn't it?
Yeah, like over 1 year is roughly 20%, and yeah, it's it goes lower over
Worse.
time,
It gets worse.
and
Yes, right.
and there's a lot of them over 10 years that simply disappear. So but again, I think that obviously active management has plenty of merit. It has a place in the industry. It just depends on the objectives, the theme, the part of the market you're talking about, and the profile of each investor. But yeah, I'll be very interested in reading about this in your coming piece. I want to ask you about the future now. We've done the past, a little bit of the present, now the future, because we have faster markets, shorter attention spans. We have obviously all these AI-driven content and headlines. And for some reason, I feel that long-term investing seems harder to maintain for investors, given all this noise. Um, in your opinion, what does it take to really sustain a truly long-term mindset as an investor?
Well, I think I said it earlier, not to panic when things go badly. But there's the other side of that, was not to think that you're a genius when you're up 30% in a year, because the market's up 30% in a year. It's even if the market's only up 20, you'll think you're a genius because you beat it by 10. You might be a genius. The thing is, it's not that the data aren't going to come out in time for you to tell geniuses from the merely lucky. So the mindset is focus on asset allocation and risk. I'm not saying not to take risks, but to manage the risks to be those which you can tolerate when things go wrong, because they will go wrong. And we've just recently had a very dramatic event where the market fell 20% in a few weeks, came back almost immediately, and then moved to new highs, which will convince some young person somewhere that there is no risk. Well, the thing is, it could happen again, and the market could fall more than 20% and not come back. And I'm old enough, just barely, to remember the whole 1966 to 82 period where the market was flat, but with a lot of volatility. So in 1966, 68, there was the Dow Jones, not the S&P, the Dow Jones reached 1,000 on a number of different occasions, up, down, crossed 1,000. And it did so for the last time 16 years later in 1982. That's a long time to not make any money. Now, you did get the dividend, but there was also a lot of inflation. So if basically, even in real total return terms, which in other words, after adjusting for inflation and the dividend, for 16 years, you didn't make any money. It
Wow.
could, again, because stock prices are high now, it could happen again. It's not my forecast. I don't think that we're facing anything like that. But there is a combination of possible circumstances where it could.
Wow. Yeah, no, that's really, really, really interesting. Thank you for
Now,
sharing that.
if you somehow hold on for 16 years, you were still paying 1,000 for the Dow Jones, and now it's 44,000. Okay, and you got the dividend. Now,
Yeah.
people have asked me, you know, a lot of capital market history. What was the all-time low of the Dow Jones Industrial Average? And I said 41. And every time the response is 41 what? 41. It's 44,000 now, or something like that. It was 41, so it's 1,000 times as valuable as it was on that day, which was, I believe, July 8th, 1932. And I remember that because it was my birthday, but I wouldn't be born again. I wouldn't be born at all for 22 more years.
It was
So,
the
Grandpa, if you're listening, put everything you have into stocks on July 8th, 1932.
if you could talk to your to your ancestors, that would be a wise piece of advice. We're getting close to the end of the conversation, so I have two more last questions for you. One is, obviously, you've been doing decades of research writing, working with institutions. You've seen economic frameworks, theories, market narratives come and go. What are some of the core principles that, in your view, have stood the test of time in markets and that still guide your thinking today, and that, in your opinion, are kind of timeless and every investor should be aware of and pay attention to?
Well, I'm going to cheat a little and get a pony off of Jeremy Siegel and Cliff Asness, who took kind of opposite positions here, but they're both right. Jeremy Siegel is very famous for his series of books called Stocks for the Long Run. And I do believe that if you had no concern about risk and you were committed to holding on for the very long run, that equities are the best investment. I would add to that global equities, because the United States, first of all, isn't the only country in the world that has stocks worth buying, but secondly, we've become a lot more expensive than the rest of the world. But as Cliff Asness pointed out in a rejoinder, bonds are also good for the long run. You have to diversify because sometimes stocks will go down and stay down for a long time. Meanwhile, in the bond market, you could be making 4 or 5% every year. Mm-hmm. Now, it's true that there's fluctuations in the price and that bonds have risk too, but the returns are very predictable. Marty Leibowitz, a big name in the field, also happens to be a personal friend, showed that the initial yield on a bond, the yield that you agree to receive when you buy the bond, is a very good predictor of the eventual return that you're going to get from holding the bond, even if interest rates go up or down in the meantime. Mm-hmm. And it's counterintuitive, but it's true. Because if interest rates go up and the bond goes down in price, you're reinvesting those coupons at a higher rate, and that makes up for the losses over a particular holding period, which turns out to be twice the duration of the bond. So you understand the concept of duration. I'm sure most of the listeners do. If a 10-year bond has a 7-year duration, then over 14 years, a policy of buying 10-year bonds and refreshing the portfolio so that it lasts for 14 years, you will get a return very similar to the initial yield of that portfolio. So the first principles is stocks are going to go up more than bonds in the very long run, because let's imagine there was only one company in the world. It issues two securities, a stock and a bond. By law, the bond is the senior security. Now, which is going to have a higher expected return? Obviously the stock, because investors are going to price it to make sure it has a higher expected return, because it has a risk that the bond doesn't have. Now, there isn't only one company, and the problem is much, much harder, but the basic principle is that the equity risk premium exists and it's a positive number. And then the other first principle is don't forget about the low risk opportunities that exist to counterbalance the fluctuations that happen when you invest in equities.
100%. And I love what you said. I'm a fixed income advisor by trade, so
interesting.
I'm in team bonds. That's music to my ears. Thank you for that. Final question. A lot of our listeners are young people that just started working in the finance industry. Some of them even haven't started yet, but are thinking about it. You are an industry veteran. If you could give a piece of advice to someone in his or her early 20s right now
to have a successful career in finance, what would it be?
Be as sociable, I guess. Get to know everybody. You're going to learn what you need to learn in order to function in the future, and I don't know what that is. But who are you going to learn it from? You're going to learn from people who are in their 30s, 40s, 50s. If you're lucky, people in their 60s and 70s will talk to you too. And so that when you want to do something useful in the marketplace, you have a list of valuable contacts. From somebody, me, who thinks of myself as not just a researcher, but something of an educator, sort of I'd be a professor if somebody would hire me, but I don't have a PhD, so they won't.
Mm-hmm.
It sounds like a strange thing to say, but I'm assuming that curious, intellectually thoughtful people are going to learn what they need to learn. The truck driver will learn to give what we now call prompts to the AI to tell it how to get to the place the truck needs to go. But in finance, almost everything is based on human relationships and human transference of knowledge. So hang around with older people and learn whatever they know, and it'll be useful.
That's a very, very good piece of advice. So you heard it. Go out there, socialize, organize lunch breaks, go for afternoon drinks.
Join clubs, go out for drinks with people, even though they say nobody drinks anymore. Drink tea.
Drink responsibly, more importantly. But yeah,
Drink
that's a good piece.
Take an Uber. Pretty soon the Ubers are going to drive themselves, so you'll be able to get home even if you have been drinking. You can already get home if you've been drinking because of Uber and their competitors.
Larry, thank you for that piece of advice. I'll make sure to follow that very, very closely. Particularly during the summer months, exactly. But more importantly, thank you so much for taking the time to talk to us. It's been absolutely amazing to get your insights. I don't get to speak to people that have been, that have been working in the industry for so long. You've shared very, very valuable insights. I loved all the historical anecdotes you shared. And to our listeners, please make sure to go online, listen to Larry's podcast, check his latest articles, the upcoming one that we talked about in the Journal of Finance that I'm very much looking forward to reading, as well as all the other stuff that he's been authoring. And Larry, thank you so much. We wish you the best of luck for the new stage that you are about to start. And you can come back to the show whenever you want. You have a friend here.
Thank you, and I'll be in touch very soon with a bunch of stuff. And can I give some information about where to find my materials?
Absolutely, please go ahead.
For the podcast, Financial Thought Exchange is the title of the series, but other people have used the phrase. So if you type in CFA, Financial Thought Exchange, it'll go right to the podcasts. I would like, if you don't mind, to show you this. It is a book I wrote about 5 years ago called Fewer, Richer, Greener. You can get the gist of it just out of the title. It's an optimistic book about the future of the world economy and the environment. Maybe we've overdone fewer a little bit, too much, but I am actually glad that the world has its population under control. And a book of essays that I've written over the years, Gold on Progress and Prosperity. That's all I'm going to show right now. There's more, but I'm probably testing the listeners' patience for commercials here. So thank you.
No, thank you. And I'll make sure to actually read those books. We can even at some point talk about them. It's crazy because in 1 hour you only have so much time to and I had so many questions to ask you.
But yeah, by any means, like if any of our listeners is interested in asking some questions about the books or wants to know more about them, please reach to Larry via
please do.
socials on LinkedIn. And Larry, thank you so much for your time, and I wish you an excellent year ahead.
Thank you, Ignacio. It's really been a pleasure, and please stay in touch.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.